This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Karina Bader, thanks very much for making a Talk Your Book debut. I know we'll get into your stock pick in a minute, but if you could just start with giving us a description of Acorn Capital and how you guys look to invest.
Thanks for having me on the show, Chris. Acorn Capital was founded over 20 years ago as a small boutique fund manager specialising in investing in emerging companies. Now that mainly means outside the ASX 250, and they tend to be companies that are small and we expect them to grow. The company itself has over 10 sector specialists with an average of 15 years of experience, and it's one of the best resourced and most experienced fund managers in the microcap space. In particular, at Acorn Capital, we've always invested in resources and energy. Acorn's always had a sector specialist dedicated to those sectors, and they've always been technical specialists with geological background. So I've got over 20 years experience. Rick, who's the current portfolio manager, has over 25, and the prior portfolio manager, Dave Ransom, which some of your viewers may know, has, he would have had over 35, 40 years experience.
And so that experience from your end is in the actual mining industry, is that right? As a geologist?
Yes, that's correct. Yes.
That's a pretty unique view when you compare it to a lot of other fund managers, how they look at deal flow, I'd imagine.
That's, absolutely correct. And as I mentioned, those emerging companies generally don't have revenue. And so what we see as our point of difference is we can look at the rocks, we can talk to the geologists on site. One of the key things we spend a lot of time on is looking at the resources, the drill holes, trying to make an assessment around the rocks, because ultimately the asset's only ever as good as the rocks that are in the ground, and you need to have a geological background to really unpick that.
And what stock did you want to talk us through today?
So today we're going to talk about a little junior rare earth explorer called Australian Rare Earths. Now, we invested in that at an unlisted stage back in late 2020, and what's particularly unique about Australian Rare Earths and their Coppermara asset is that it was identified as an ionic clay deposit. Now, traditionally or historically, those kind of deposits have only ever been found in China. And so to find one here in Australia in a first world jurisdiction in a commodity that is undersupplied, we really thought that that was a great opportunity for Acorn, and is significantly why we invested at such an early stage in that company.
And maybe contrast for us the difference between an ionic deposit and a hard rock deposit in rare earths, and why perhaps the ionic ones were more appealing to you.
Great question. So in rare earths, there are generally three types of deposits where you can extract your rare earth elements. Interestingly, there are 17 different rare earth elements, but only 4 of them are what we'd call economic. And they tend to be the ones that the Western world governments have actually applied and stated as critical minerals and put them on a critical minerals list. Now, there are ionic clay deposits, which we've just spoke about. There are what's called bastonite deposits, and then there's monazite deposits. Now, the bastonite and the monazite deposits tend to be more expensive to develop, more technically challenging, and take a longer period of time to get into development. Particularly monazite deposits, which tend to be what's the standard produced by a company, say Lynas, that's currently in production. They have one of the waste products of processing monazite to extract the rare earth is uranium and thorium, and that can contribute to material handling issues down the track. Bastonite deposits don't so much have the uranium-thorium issue, but what they tend to do is those deposits have the cerium and lanthanum rare earths, which are not of high value, tend to be the lower value products. However, so it's really important when you look at a rare earth company that you're looking to invest in, the percentage of those 4 critical elements in the deposit, and they are neodymium, praseodymium, they're tongue twisters, dysprosium and terbium. And they're the ones that actually have a high value, and you'll get a good basket price when you sell your product. And in particular, Australian Rare Earths, 25% of the assemblage is those 4 critical minerals. Other deposits may not have such a high percentage of those particular 4 elements. So that's really what you need to look out for.
So I wouldn't mind coming back to your journey into this stock and that journey from being private to public. But maybe before we get to that, just maybe what's your top-down view for rare earths as a commodity? You've sort of touched on what the commodity's used for, but I know China control a huge amount of the supply. How are you viewing that top-down dynamic at the minute for the rare earths industry?
So I mentioned before that ionic clay deposits have traditionally only ever been discovered and exploited in China. And actually, the reason that China tends to dominate the supply chain today is because they had these ionic clay deposits. And those ionic clay deposits are at surface, they're free dig, they're low capital to get into production, quick to market, and that gave China a significant advantage over the rest of the world. And they still dominate today. As you said, over 90% of production comes out of China today. So the reason we like rare earths in particular is both a geopolitical lens, but also a supply deficit lens. When you look at the transition to a renewable economy, and we're starting to see this massive build-up in momentum to achieve the decarbonisation targets by 2030, if you look at how we are going to achieve that as a society and the increased demand in wind turbines in particular to generate that energy, and then in electric vehicles to also reduce those emissions in carbon dioxide. Those two features require rare earth, in particular the wind turbines. So, for example, a wind turbine requires about 600 kilograms of neodymium and praseodymium. And if you drive out to Western Victoria towards Stawell, you'll see that those wind farms, that's about the size of the 600 kilograms required for those wind farms. But if you're building out at the North Sea or potentially off the coast of Victoria soon, you need 3 times the size of those wind turbines, which requires 3 times as much of the neodymium praseodymium. And the reality is the market's currently undersupplied today. It takes decades for these projects to get into production. I just can't see us meeting that need by 2030, given the increased demand just for wind turbines. And then we talk about electric vehicles and the take-up that we've seen in the last 2 years of those. Electric vehicles particularly use rare earths and magnets because it makes the cars lighter, and obviously that feeds into the range that you can get in your electric vehicles, which is clearly an important selling point of electric vehicles.
Coming into this as originally when it was unlisted and obviously seeing a material markup in the valuation of becoming a publicly listed entity, am I right in saying, a lot of private investors might have a high conviction bet, and because they don't have monthly mandates or as much liquidity requirements as funds, they're able to hold through longer cycles and funds where, they maybe need to be more aware of liquidity of the investments they're in, and they're often shaving positions that they still like just because either liquidity becomes a concern or it's become an outsize for their portfolio. How has that sort of been tackled by you in this investment, where I assume it started off quite small and has grown to a material position?
Absolutely. So I probably should have mentioned before, Acorn Capital is a crossover fund. All of our funds do both unlisted and listed. However, we do cap those unlisteds at about 30% of overall funds under management. Having said that...
Sorry to interrupt. And do those unlisted positions need to have a liquidity event in a certain time period?
We have a 2 to 3 year view,
yeah.
So we would anticipate that there's a liquidity event within 3 years, but it could be a trade sale. It doesn't have to list on the ASX, that's our preference, but it doesn't have to. In fact, we've had companies list elsewhere, but it needs to provide an opportunity for us to have that liquidity. Absolutely, that's a prerequisite, and we will ensure that we have that up front. So we never would have invested in AR3 as an unlisted if their intention was never to list it. We would never have done that. So in terms of the AR3 investment, it was a tiny investment. In fact, I'd say that was the smallest investment Acorn's ever made at the unlisted stage. It was around a $2.5 million valuation. It was a very small amount of money.
Wow, it's almost a seed deal.
Yeah,
a shell deal, sorry.
It was almost and literally, it was a couple of tenements. It was founded by Rick Pobjay.
You'll fit right in this office going into the 2 million EVs.
We don't, like I said, it was the smallest we've ever done. It's not our usual MO, but because our view around resources and rare earths in particular, we felt that this was a really unique asset. We put that money in the seed, and there was risk because at that stage we still didn't know that it was going to be an ionic clay. Rick Pobjay had worked in mineral sands previously in Victoria, had identified the tenements and the assay results and worked out that he thought this was an ionic clay, but it still had to go for metallurgical testing to prove that. So the seed funds were basically to get them through a drill program, get the samples, send it to the lab, and then establish that it was ionic clays. So when you talk about that uplift in the value from the unlisted to the IPO mid last year, by the time it came to IPO, we knew it was an ionic clay. We had a small resource on that asset, the yellow tail and the red tail that you mentioned. And so it IPO'd with about a $25 million valuation, which in a comparable level on the ASX is a very low valuation. As you've also mentioned, we held on to that Through that process, we contributed to the IPO, and we just contributed most recently to the latest capital raise. But it is still a fairly small position for the company overall. We can hold companies that have over $1 billion in market cap, so a $25 million asset was a very small percentage of our funds. So from a liquidity point of view, as from a FUM level, irrelevant, it did not have any significant impact. Clearly from a AR3, Australian Rare Earths, liquidity of its register, that is where you might come into issues if you try to divest.
And you've mentioned before the different jurisdictions. Like, I've been an investor in IXR, I'm now out of the position, and they've got looks like a great deposit in Uganda.
Absolutely.
But it's in Uganda. You know, how do you sort of handicap jurisdictions when you've got, you know, Canadian, US, Australian jurisdictions compared to ones where there's the high potential for unpredictability?
Look, we have an actual quantitative process where we actually take account of sovereign risk. So we have a mathematical formula that we use based on the sort of Fraser Institute jurisdictional issues. We factor that into our original valuation of the company. However, in addition, so Acorn is an equity investor. We tend to be high risk. We will invest in more marginal jurisdictions. There are some jurisdictions just we won't touch.
Which ones won't you touch, if you don't mind asking?
Well, I wouldn't go into Russia.
Yeah, well, okay. With South Africa?
South Africa, the Stands.
Congo?
The Congo. Historically, Acorn has invested in the Congo.
Congo's got some great deposits, but
exactly. So,
if they're not yours.
And part of that is when you look at the market, you can have a fantastic tier 1 asset in the Congo, but the market's never going to give you full value for that. It's going to trade like we talked about thermal coal assets with a discount. Now, I can't tell you exactly what that discount would be, but at least it's going to be a 50%, let's assume.
Yeah.
And so the question is, so are you ever going to get... And knowing how hard it is to get any asset into production anywhere globally these days, are you really going to invest your money and follow your money in a jurisdiction where you could have spent so much money and time and at some point something happens? And there's a company just recently going through exactly that in the Congo, incidentally, and to have essentially lost that investment.
What about Spain? I've heard there's one area of Spain that a lot of investors don't mind, but the rest of it, they reckon it's just as bad as
generally
parts
has
of
been
Africa.
problematic for Australians. There's been a number of Australians over the decades I've been at Acorn Capital who have tried to invest in Spain, and some of them are still standing, and it is now starting to look like it is opening up.
Okay.
You've had Highfield get their approvals through. You've seen there is another company in Spain.
Berkeley and Urgia, they've been stuck, haven't they?
Yeah, they've been stuck, and because it's uranium...
Yeah. It's a nice little deposit too.
Yeah, and well, that's right, and it's previously mined, so you're not coming from a standstill, right? You're actually coming in at a sort of relatively developed stage just have to put it into production, so you're not even got any risks to an extent around that. But on the ASX, there's plenty of other opportunities in uranium, so you don't have to take on that risk if you don't choose to. And that's the beauty of the ASX. We've got a really deep resource cohort to invest in, over 600 stocks outside the top 100. But more than a $10 million market cap. If you include the ones that are sub 10 million, you could almost double that number, and they are across all commodities and all stages of development, and that's the beauty of that sector which we're investing in. And that's how we run the portfolio as well. I digress a little bit, but it's commodity spread plus stage of development spread, and then within that we risk manage the weight according to a lot of the factors that you've talked about. So if you see a fantastic asset in a jurisdiction that you don't like, you just won't hold it at the full weight that you would have if it was located in a different jurisdiction, if you really felt that that was the only way to get exposure to such an excellent asset. But the reality is, if you look across the ASX, you can probably get a similar exposure somewhere else.
I'll come back to AR3 in a second. I know I've distracted you from the focus here, but just coming back to that jurisdictional risk, I know you've got a quantitative process now, but qualitatively, intuitively, I assume, does it feel that those risks are only going to get bigger over the next 5 years as, you know, the hunger that a lot of these countries are going to feel, let alone all the other unstable risks look like they're going to rear their head?
I think that's really quite true. Since I started at Acorn in 2009, I would say the jurisdictional risk generally has increased, and obviously what's happened in the last few months with Russia invading Ukraine, you can clearly see that geopolitical risk has gone up even more. Can you put a number on it? No, but what you can do obviously is continue to look for other opportunities. But it is without a doubt, and it's not just jurisdictional risk in terms of, say, Russia. Well, clearly you're not going to go invest in Russia for obvious reasons, but there are permitting risks. And this is one of the key features of the junior resources space. You can find and discover an asset, great, but you've actually then got to move that asset from being a discovery and a potential hole in the ground into actual production. And the reality is you have to raise capital to do that, whether it's through debt or equity or strategic investors, off-takers. There are a number of ways you can do it. But that process has taken longer and longer and longer. And if you look at any commodity now, except for perhaps gold, it is generally a 10-year period of time from discovery through to production for any asset. So if you make a discovery today, on average, it's going to take you 10 years to generate any cash flow from that asset. And that is across the board, whether you're in WA, whether you're in Northern America, South America, Africa. And that's a working capital issue. And that's the issue with junior explorers, make the great discovery. That's fantastic. We're all happy. Everyone's making some money. But now all of a sudden, I need to do my engineering studies. I need to put all my environmental permitting issues in place. I need to talk to the government. I need to work with the landholders. And a lot of those features are outside control of the company in terms of the timeline. And so you've got to keep funding the business through that stage to the point where you've actually got what we call a DFS, a definitive feasibility study, and you're ready to make that financial investment decision, or FID. Push the button, we go raise the money, we go build this project. That's a really long time frame.
And getting back to AR3's project, in terms of the drilling at Coopermurra, maybe talk us through what the results you're seeing there, maybe what's their mineral resource estimate up to, and where does it need to get to for you to go, right, this is going to be a proper, sustainable, long-term mine?
Look, it's about a 15 million tonne resource at the moment with about 700 ppm, which is in the rare earth space is considered low grade, but then you've got to come back to what I mentioned earlier about ionic clay deposits. The very nature of those deposits are that they are lower grade than, say, a Mount Weld at Lynas, which has a 14% rare earth content. However, because it's at surface, it's within 3 metres of surface, it's free dig, it's in a infrastructure-rich part of Australia, believe it or not. The mine manager that I met on site a couple of weeks ago who's doing the test pit, she's a local. She happened to be retiring into Narracourt and then discovered that AR3 were going to build this test pit, and she put her hand up and said, I want to work here. So there are a range of skills in South Australia that they can have already tapped into. So it's not the beauty of this particular process method for ionic clays. If you think of ionic clays as the rare earths are attached to the clay particle on the outside and it adsorbs off in the processing process. So it's like having a glove on your hand, you sprinkle a little bit of weak acid, like a hydrochloric acid, and it'll slip off. And then it goes into solution, and then you can process it through your plant and send it to your next stage of processing elsewhere. So it's a very low capex build. So whilst it looks small right now, obviously they've done some recent drilling, that resource update is imminent. It should be coming out in the next few weeks. It should be a material uplift. Not only have they drilled a larger area, they've also, the metallurgical test work has identified that their specific gravity was lower than initially anticipated. That allows them to increase their resource. They've also infilled and increased the confidence of the resource. So you'll get an increased resource, better confidence from inferred to indicated, all of which leads you to ultimately being able to put out a reserve, which is the mineable asset. So it's going to grow. They also, earlier this year, did regional drilling, 20, 30 kilometres away from where the existing deposit is, also hit rare earths of a similar size with similar grades. So this is a regional play. So whilst this initial asset, which was sort of the first place they started, and the only reason they started there was because there were previous drill holes that had already identified that this had good quality, good grade rare earth. So they drilled around that initial information. Now there's still this huge, and that's yet to be developed by Australian Rare Earths. I mean, that's the longer term story here. Whilst it's, and because it's a low capex, I can't stress enough, the fact that it's a low capex build means you can get into production at a much smaller scale than some of the comparable peers. It will produce a lower volume of rare earths because of that, but the economics will still work because there's low operating cost. And let's face it, South Australia has mostly renewable energy. Not only will you have low energy prices, you'll have green energy. You'll be able to sell this product we talked about this, the premium, both from an ESG point of view. So from cradle to grave, this rare earth will be able to feed into an environmental ESG aspect that the car manufacturer and the wind turbine manufacturers can tell their customers. Your renewables not only coming from the wind, but the material that we've used to put into that turbine also had a low carbon footprint. And that's a very unique. So when I said the part of the reason we're invested in Australian rare earths was the rare earth commodity itself and its undersupply, but that metric around ESG and how this particular deposit in this particular jurisdiction can really magnify the ESG credentials.
And I think you were part of the $8.1 million capital raise they did recently.
Correct. Yep.
How far along does that money get them into? I assume it doesn't get them all the way to DFS, does it?
No. So that will. They had 7 in the kitty at the end of March. The raise brought them in another 8, so they're now sitting on about $15 million of cash. This is well and truly enough to get them through the next 18 months to 2 years. So they will need more funds, as all junior explorers do. We, as you mentioned, we participated in this raise, and we're well and truly capable of continuing to support this business over the long term. And we do feel that there are some particularly critical elements of this deposit that make it unique.
And so what's its they've got a heap of options and stuff on issue. What's its fully diluted market cap?
I'd have to get back to you.
130 million shares.
I think it is 130. So there's $5 million which could come in through the options, which were just issued in this raise.
Yeah.
If it hits a 57 cent. So they
are.
I
want to go with somewhere around 90 mil in current prices, fully diluted market. Does that sound right?
No.
Lower than that.
Lower than that. Yeah. So if you include the raise, I'd have to come back to you with the full numbers.
Well, what's the share price? About 45 cents?
It's sitting at about 48 this morning.
48, so 48.
But I don't think the shares have been fully issued through.
Which is pretty small.
Yeah.
Let's leave it at that.
And if you take
what is it comparable?
If you take the 15 million of cash out, it's sitting on an EV of around about 35.
Yeah.
So that is still an incredibly low value, given the stage this company's at, where they're about to publish an updated resource. After that, getting to your question about catalysts, they'll have the further metallurgical test work. So we haven't actually talked about the test pit that they just executed in South Australia. The purpose of that was to get ton-sized samples throughout the soil profile, and they'll be sending that to the lab, and that will really feed into the pilot plant testing of this resource and what the process flow sheet's going to look like. And ultimately that all feeds into the engineering on what the capital at the... But if we look at a comparable like Ionic Rare Earths, they published a scoping study last year, and I think they gave their capital at about 120 Aussie. And Sprott Capital have recently published a research paper on Australian rare earths, and they used about 100 million for the capital requirement to get into production. And that's what I'm talking about, it being a low capital, imminently. I mean, you can say it's got a 48 million market cap today, but it is still an achievable capital for any junior explorer in the Australian market to raise to get into production. Rare earths are a little bit different to other commodities like gold and copper. There's no exchange that you can go and hedge your bets on, and so consequently banks just MIA in this space. Banks don't come to this market.
Even with offtakes?
Even with offtakes.
Because there's no price.
Some foreign banks consortiums do. Export financing agencies have come to this market, but not standard banks.
I know you couldn't bank on it. Do you think things like that will have to change as the urgency to replace oil is going to heat up, particularly if oil gets north of 200? Do you think these things are going to have to be revisited with a bit more urgency? Because...
That's a very good question. I mean, we've seen the Australian banks completely exit the resources space. The only time they come to play is on a gold developer. Lithium can't get bank debt, and they're in production printing millions of dollars a quarter, and they can't get bank debt. So, once you're in production, you can get a corporate debt facility, but to get that project debt that you need pre-cash flow, you won't get... yes, logically, you would say the banks would have to come to the market. However, Australian government has set up a range of funds. The Export Financing Agency have been issuing low-cost loans to resource companies. What's called the Northern Australian Infrastructure Fund have also been supporting critical minerals companies. So Australian government has published a critical minerals strategy, and part of that strategy is the EFA and the NAIF are putting loans. Now, the beauty of those loans are they're long-dated, 10-year amortisation, lower interest rate than commercial banks, and they will allow themselves to sit subordinate to other debt providers. So that allows a company to get a fair proportion of their debt package away, and then they can use the rest through offtake or strategic partners. And you've seen that through a number of other entities today, you've even seen the Australian government support Iluka recently with their rare earth plant that they're planning to build in WA. And that, interestingly, is from those monazite assets, deposits that we talked about. So they will have a uranium and thorium byproduct that they have to manage. Lynas is bringing their cracking plant back from Malaysia, which will double the size of their production. It's also a monazite asset, but she's funding that herself. She's raised money to do that, doesn't need to come to banks to fund that.
I'll let you go in a minute. Just one last question on that related issue. We're seeing so much news about the cost of living increases, obviously in Australia, but I was recently in America, and it's, inflation's higher there and even more of an issue. But so many of the policies, you look in the UK, for instance, they've just announced a subsidy for electricity bills for everyone, $400, which, makes sense, but won't reduce the actual cost of electricity. But then they've also implemented a super profits windfall tax on oil companies at a very time when you need... The only thing that's going to reduce those cost pressures is the coming down of commodity prices. Yet they're disincentivising money going in the ground, and you're seeing these policies reenacted in different ways all across the world at a very time when everyone's screaming about cost of living pressures. Does there feel to be a sort of a knowledge gap between policymakers and how these real-world commodity prices impact inflation, do you think, or what's going on there?
Look, I think we're suffering in this country from a decade of inaction and inability to get alignment between states and federal government policies. We're seeing a gas crisis on the east coast of Australia in terms of the price of gas, and we're the largest gas exporter on the planet. How does that work? So you're absolutely seeing that there's been a failure of policy, particularly for Australia, and you are seeing these other policies being implemented globally. Clearly there's been a short-term shock with the invasion of Ukraine that at some point would look to be alleviated. You are now seeing that Japan is talking about turning on their nuclear reactors. About a decade ago, or just over a decade ago, they had the big tsunami which damaged all of their nuclear reactors, and they've really only they had about 25, don't quote me on the numbers, but it was about 25 nuclear reactors in the country operating. After that, they shut them all down, and then they have only really turned on about 3 to 5. So there's still...
My dad, Andy from Sandy, had a big position in Extract Resources, and he was waiting to sell just before Fukushima happened, and did he hit
Don't
the
worry,
roof?
we all suffered through that uranium downturn, I can assure you.
Shout out to Andy from Sandy.
So Japan is one of the biggest buyers of our export LNG gas.
Yeah.
Now, if Japan does work on turning on their nuclear plants, that gas then becomes available for a global redirect, and that theoretically should start to alleviate some of those global gas pressures. That should then alleviate our East Coast gas pressure. How quickly that happens, that's a 12-month, 2-year type of time frame. How do we deal with the cost of living pressures today? I think you will see a subsidy. It's my personal opinion, because that's the only way. Even the government says we can press this trigger to make these exporters return more gas to the market.
But those subsidies all around the world is going to increase the price of said commodity, isn't it? It's like giving a first home grant to buy a house. Pretty soon the price of the house.
So what you're going to see
is
demand destruction. I've looked into it myself. How do I degasify my house? I've worked out it's probably going to cost me $25,000 to replace all my gas appliances and get the person in to do all that work. But it's possible and it's doable, and if gas prices stay high, which ultimately also feeds into electricity prices, you will see demand destruction. And it will be a case of those who can afford it will implement that activity. And then the question is the other part of the market who haven't got the resources, or they're renting and they have no control over where their energy comes from. Those are the groups will need to be supported through this transition. And that it is a transition, and it is going to take a long time. I don't really have the answers. All I know is that the renewable energy commodities are in huge undersupply to 2030 and beyond. I just can't see how the world can produce enough of those commodities to meet this need. And the higher prices go for oil and gas, the more the demand for those go up. It's a substitution. And I've been talking to companies in recent weeks and they've said, yeah, you know, we looked at solar panels 2 years ago when we were looking at our project build and it just didn't quite make sense, so we shelved it. But now when I'm paying these diesel prices, that solar panel makes sense. So I'm going to put a solar plant now on my mine site instead of a diesel generator.
Beautiful. Well, it's as good a place as any to finish. We took you on a journey from to Uganda to rare earths to renewable energy and back again. So thanks very much for talking us through AR3 and sharing the story. Really appreciate it.
Thanks very much, Chris, and it's been great to be on the show.
Thanks, Karina. This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.